Welcome to the Albion Financial Group Environmental, Social, and Governance presentation and slide deck. At the intersection of values and money, an intro to ESG investing. This presentation was first given at a Women of Albion event on February 25th, 2021. With that, let's jump right into it. Larry Fink, the CEO of BlackRock, one of the largest, if not the largest, financial services firms on the planet, once wrote, "Society is demanding that companies serve a social purpose. To prosper over time, every company must not only deliver financial performance, but also show how it makes a positive contribution to society." Now, it was unexpected that we would get any inspiration from the CEO of the largest financial firm in the world, but nonetheless, we'll take it. And Larry's a good guy, and he really cares about these important topics. And hey, it turns out Milton Friedman was wrong. The purpose of business is not just to squeeze as much profit as possible for its shareholders and maximize financial returns, but rather companies can and should do more within a broader mandate to provide the goods and services we want as a capitalist system, but also to do really good things, achieve impressive feats for our communities and for society at large. Profits and social impact are not mutually exclusive. As Seth Godin aptly described, quote, "The myth is that the only purpose of a company is to maximize profits. That's a fiction and a dangerous one. Organizations exist to make things better for people, not the other way around." That's so true. In other words, doing well by doing good. So what specifically is ESG? Well, it's an acronym that stands for environmental, social, and governance. The E, environmental. Companies that have a climate change strategy, that embrace biodiversity, water efficiency, energy efficiency, are monitoring and managing their carbon intensity and their carbon footprint, that care about the technology and the opportunity around implementing environmental management systems to help reduce the impact of their environmental activities. The S, social. Equal opportunities at the company for employment, for advancement. Freedom of association, not penalizing people for who they choose to love or beliefs they hold dear to them. Health and safety for every employee, for their vendors, for everyone along the supply chain. Human rights, customer and product responsibility, making sure that they're not sourcing components and services from countries that engage in child labor practices. Governance, the G, having a mindful eye toward business ethics, a culture of compliance, caring about board independence, having voices from outside the company represented on the board, paying attention to executive compensation. Does it make sense that the CEO makes 500 times what the average worker of the company makes? Equal pay for equal work, shareholder democracy. These are all extremely important, and they're embodied in the quote above by Mr. Fink. They're the basic building blocks to ESG investing. And this is really important stuff. And the good news is it's a market that's growing in awareness and interest. In 2005, there was less than 1 trillion invested in sustainable companies. Today, it's around 17 trillion, having grown over 50% since 2018. It's now a hot space. It's in vogue. But at Albion, I'm proud to say that we've been ahead of that wave. We first began contemplating an ESG offering at the end of 2015, but we didn't want to just do ESG for the sake of having a marketing tool. Rather, we were passionate about doing it right. For me personally, my wife and I have been committed for years in lowering our carbon footprint. We've driven electric vehicles since 2013, went LED throughout our home in 2015, full solar on our rooftop in 2016, and around that time actually replaced our grass with artificial turf and zero-scaped everything around our home. We took our red meat consumption down to almost zero around the same time and have kept it there with wonderful products like Beyond Meat, Impossible Foods, Nature's Find, which is a new one we've come across. We've abjured bottled water and are avid recyclers, teaching both of our young kids, a son and a daughter, the importance of these practices. We also decided to contribute more to organizations we believe to be good stewards of our planet and community. This lifestyle met serendipitously with Mr. Fink's quote one day a few years back. A light bulb went on, and our ESG initiative was born. So back to present day, and with some encouraging statistics. A recent Morgan Stanley report on ESG showed that around 90% of millennials would like to have ESG options when investing. This is up around 10% since 2017. 78% of female investors are interested in ESG, up around 5%. And 85% of all high net worth individuals have a desire to align their values with their dollars. This is up about 9% over the same period of time. Overall, around 76% of investors say they'd prefer to use an advisor with an ESG option. So, what are the influences driving this momentum over recent years? Well, we think the Paris Climate Accord, which was adopted originally in 2016, has sensitized more and more investors and asset managers to think sustainably. More support and attention being placed on the social justice movement has absolutely moved the needle here. More studies emerging suggesting that investors don't have to give up returns to work towards positive societal outcomes. We'll talk a little bit more about this in a moment. And yet, despite its growing allure, less than 40% of asset managers and financial advisors are currently offering ESG options to clients. Of those, the bulk of this is driven by client demand as opposed to the advisor doing it out of want. Indeed, these same surveys show that only 10% are driven by the firm's personal values or interest. At Albion, we fall into that 10% camp, and we're very proud of it. So why does ESG matter? Well, quite simply because all of us want to live in a better world. We have seen the mounting physical toll of climate change in fires, droughts, floods, and hurricanes. We've also seen the direct financial impact as energy companies take billions in climate-related write-downs on stranded assets, and regulators focus on climate risk in the global financial system. As Mr. Fink recently said in his annual letter, climate risk is investment risk. We agree. But it's not just about climate, the E in ESG. The recent global pandemic has been a gloomy reminder of the risks we face if we do nothing. And despite the darkness of the past 12 months, there have been signs of hope highlighting companies that have worked to serve a broader set of stakeholders, the hallmark of good ESG investing. With courage and conviction, we saw businesses rapidly innovate to keep food and goods flowing during lockdowns. Companies have stepped up to support nonprofits serving those in need. In one of the great triumphs of modern medicine, multiple vaccines were deployed in record time while healthcare providers and clinicians poured their resources, time, and sweat into treating and caring for COVID patients. Many companies also responded to calls for racial equity, although much work remains to deliver on these commitments. And yet, strikingly, amid all of the disruption of 2020, many businesses move forcefully toward confronting these challenges and become better stewards of our world. While ESG investing is certainly not a panacea in meeting all of these challenges and then some, demanding more from our companies, more from our investments, does matter. We mentioned the Paris Climate Accord. With the U.S. rejoining this agreement under the Biden administration, 127 governments responsible for about 2/3 of global emissions are considering or already implementing commitments to net zero. Momentum continues to build, and in 2021, it will accelerate with dramatic implications for the global economy. Now, setting this type of example at the highest levels can compel and inspire firms to figure out cleaner global supply chains, set specific carbon targets, and create industrial recycling programs, of which, in concert, helps to move everyone and the climate in a positive direction. Racial injustice and improving diversity inclusion likewise cannot be solved without leadership from companies. A company that does not seek to benefit from the full spectrum of human talent is weaker for it, less likely to hire the best people, less likely to reflect the needs of its customers and community in which it operates, and are thus less likely to excel. Across codes of conduct, ethics, compensation, reporting, and culture, a company's governance practices are critical to operating performance and promoting fairness. In sum, investors demanding that companies focus on these areas and doing well by doing good plays a key role in bringing forth the attention and change needed to make a difference. To be sure, this will require both technological innovation and planning over decades, and it can only be accomplished with leadership, coordination, and support at every level of government, working in partnership with the private sector to maximize prosperity and best outcomes. Questions of racial justice, economic inequality, or community engagement are often classified as an S issue in ESG conversations, but it is misguided to draw such stark lines between these categories. For example, climate change is already having a disproportionate impact on low-income communities around the world. Is this an E or an S issue? What matters, what matters less are the categories we place these questions in. More critical is the information we have to understand them and how they interact with each other. Improved data and disclosures will help us better understand the deep interdependence between environmental and social issues, while governance is part of the toolkit required in quantifying and qualifying delivering on these endeavors. This more nuanced view helps to inform our approach to building a thoughtful ESG portfolio for clients. I mentioned previously that over the years, 17 trillion in assets have been plowed into ESG type investments. That number represents 32% of the 53 trillion in total current US equity value. This growth and awareness are powerful, but not all ESG is created equal. Given the growing interest in ESG, many new players have entered the landscape, and many of these are large institutions that are more interested in marketing than meaning. According to Morningstar, the 10 largest ESG funds presently account for around 39% of all ESG invested assets. We further know that the most significant inflows have gone into pooled funds, community investment institutions, and alternative investment ESG vehicles. Over the past 2 years alone, growing by 200%, 44%, and 22% respectively. This data is according to Chris Phelan, the research manager at the Forum for Sustainable and Responsible Investment. Now, this isn't necessarily bad, but rather it simply underscores the concentration, herding, and groupthink that inevitably asphyxiates Wall Street on nearly every subject and idea. So how do we do ESG? Most conventional stock picking focuses almost exclusively on things like earnings per share, cash flow per share, book value. But with our ESG methodology, we are also transfixed by attempting to gauge impact per share. To be clear, this isn't to suggest that we shun those more traditional fundamental metrics. We certainly do not. Again, we're seeking companies doing well by doing good. Central to our ESG portfolios is the requirement that we invest in healthy companies sporting attractive investment themes and opportunities while also being selected for a wide range of social criteria. It is a dual mandate driving this portfolio. At the top of the funnel, this means avoiding holdings in industries that are intrinsically wholly unacceptable, like tobacco, weapons of war, handguns, fossil fuels, mining, unhealthy eating, dirty manufacturing, etc. And we carry out this complete research in-house across all three areas: environmental, social, and governance. Throughout this process, we take a fairly unique approach in that we size up this ESG merit not solely based on what's happening now, but leaning heavily on a company's overall ESG philosophy, objectives, strategic goals, and how well they are meeting these targets. It's where the concrete meets the philosophical, and it's an important distinction. We unequivocally want companies doing laudable things today. But just as important is their work in diligently striving for the betterment of tomorrow. This not only makes sense in our view, but seats us ahead of the ESG analysis and dialogue to come. As such, perhaps the richest definition of a modern corporation in the 21st century is how Microsoft CEO Satya Nadella recently defined it. Companies finding profitable solutions for problems facing both people and planet. Now, there are a couple of key words in there. Profitable is important because surely it's a motivating factor for innovation and finding solutions. But problems is the other key word for people and planet. So we think what may happen over time here is, as we go forward in the 21st century, if you're a profitable corporation, but you're creating more problems for planet and people, it'll catch up to you. But companies that care and address all of them in a seamless and positive way will be good for business. And if it's good for people and planet, and that's good for business, it will ultimately be good for our investments in these companies. Now, when looking at the investable universe for ESG, there are more obvious choices like solar, wind, and water companies. And this is where most ESG managers' due diligence ends. However, companies like Salesforce, and Visa, even Clorox, and semiconductor equipment manufacturer Applied Materials. The boards and executives of these corporations are taking this stuff very seriously. A moment ago, we talked about Satya Nadella and Microsoft. These folks have a goal of 2030 to be running beyond carbon neutral. In other words, carbon negative. And by 2050 to have captured back all of the carbon impact they've had as a company since their founding in 1975. Let me say that again. Over the next 28 years, Microsoft plans to capture back all of their pollution, their entire historic carbon footprint since inception as a company. That is huge. That's an audacious goal and an expensive one. They are also doing things like putting billions of dollars into research and an innovation fund to find smart solutions for the many challenges facing our planet. They're also exploring sustainable data center strategies, things like their Project Natick, where they are testing the concept of submerged data centers 300 to 400 feet beneath cold ocean waters in order to pioneer sustainable and energy-saving data centers, while still dispensing reliable computing power that our 21st century economy needs. Circling back to Visa, they have a goal to use 100% renewable energy across their entire global operations by the end of this year. They are also striving to reduce waste, including paper by some 35%, as well as conserve water across all Visa properties. Visa is also committed to diversity and inclusion, as well as having a board and management structure that focuses on high ethics and transparency, of which they score quite well. As for Applied Materials, this is a company that consistently ranks as one of the most, quote, ethical companies globally by Ethisphere, as well as a top, quote, green company by Newsweek, and a top 100 is ranked by the EPA. The company's practices are guided by a desire for overall corporate responsibility, including improving diversity within their ranks, pollution preventage, water conservation, which is really important in the semiconductor business, by the way, avoiding conflict materials, and improving energy efficiency. For example, Applied Materials headquarters in Santa Clara recently announced that it receives 100% of its power from beautiful green renewable energy sources. Clorox. This is a company whose chairman of the board and CEO until just last month before he passed the reins off, his name is Ben O'Dorer, has clear published goals on greenhouse gas emissions and corporate energy use. He's been phasing out controversial substances, adding in natural product lines, and promoting diversity within its ranks. In fact, the new CEO, Linda Rendell, is a wonderful illustration of this. Dora lives ESG personally, like many of us at Albion, down to the minute detail, and encourages employees to do the same. The guy takes the BART to work, eschewing corporate SUVs and fancy travel. I don't know many other CEOs that do that. And we don't discount such efforts. Sometimes it's the little things that speak the loudest. Those companies are but a few examples of the investments in our ESG offering. We also may use selective ESG ETFs to gain exposure when and where appropriate. And like all of our portfolios at Albion, we believe in owning good businesses for the long term, carefully designed and diversified. Our definition of long term is, well, as long as possible, provided the company is continuing to operate and behave in a manner consistent with why we bought it. We also are mindful of valuation, or the price we pay for the value we receive of the underlying asset. Our collection of ESG stocks in the portfolio are comprised of companies from a variety of sectors. And while we do invest in green energy firms, we also think bigger than that, providing our clients access to responsible corporate champions in technology, healthcare, finance, and wide moat consumer growth stories, cutting across industry subcategories like software, cloud, retail, healthcare innovation, sustainable infrastructure, and unique environmental solutions. You can see here, this is just but a quick representation of the Albion ESG portfolio apportioned out by sector. You can see we have 36% in technology and communications, around 9% in healthcare, 17% in consumer companies, a little bit of financials in there at 7%. Got some industrials, some real estate. 20% of it is green energy, that traditional category that we talked about a few moments ago briefly, but 0% traditional energy. And of course, 0% of those industries and categories that we consider wholly unacceptable. If you're interested in our ESG strategy as it pertains to implementation, it's important to recognize that it's not an all or nothing. We have clients and prospective clients that do want a full allocation to ESG. They want every stock in their portfolio designed and apportioned based on Albion's model ESG portfolio. And that's great. We celebrate that commitment. But we also recognize that clients may only wish to have a slice of their stock allocation invested in such a way. And here, with the power of new productivity tools at Albion, a back-end technology stack called Tamarack. By the way, a sincere shout out to everyone at Albion who may help make that big lift happen. It's been a monumental change in our technology stack, and we couldn't have done it without all employees at the firm. But because of Tamarack, because of this, we can now better provide tailored ESG sleeves into your overall equity allotment. Through this approach, you won't collect all 35 to 40 ESG investments contained in our model portfolio, but you will receive a scholarly slice of these laudable businesses. We're really excited about this capability in democratizing ESG for our clients. So how can we know and monitor these things? How can we measure commitment and progress from the companies we invest in? It wasn't very long ago that sustainability reporting was perceived as a corporate backwater, but now it's quite ubiquitous. As of 2019, 65% of companies in the Russell 1000 published corporate sustainability reports. This is up from 22% back in 2015. By market cap, this amounts to around 90% of the largest 500 companies by market cap in the index, per the Governance and Accountability Institute data. And the trend of ESG reporting is only getting better. Just this last September, a group of 5 sustainability reporting organizations, the Sustainability Accounting Standards Board, the Global Reporting Initiative, International Integrated Reporting Council, the CDP, and the Carbon Disclosure Standards Boards all joined and said that they plan to work together to develop, quote, a comprehensive global reporting system. Then in November, BlackRock, recall that's Larry Fink's shop, issued a widely esteemed paper calling for a convergence of standards, a single reporting framework for ESG to, quote, achieve a globally recognized and adopted approach to comprehensive reporting. Additionally, the big 4 accounting firms, regulators, and even global central banks are increasingly focused on climate-related risks and sustainability reporting more broadly as important drivers of their financial stability frameworks. Transparency is advancing. The information is out there, and it's regularly updated and published. The public, investors stipulated this action, and so it is. These metrics measuring, quote, stakeholder capitalism, as we like to call it, including ESG indicators and disclosures for financial markets, investors, and society, are designed to make benchmarking sustainable business performance easier. Klaus Schwab, who's the executive chairman and founder of the World Economic Forum, observed, this is a unique moment in history to walk the talk and to make stakeholder capitalism measurable. Here's what these reports often look like. You might be asking yourself, how do you know that these companies are doing what they say they're going to do? And again, how do you measure it? We talked about some of the different initiatives out there, but what does that all mean? What these reports do is they cite targets. They provide progress along the way, obtainment scores, and other metrics to demonstrate that they're doing what they say they're going to do. This is one from Albion ESG Portfolio company, Adobe. You can see here this snapshot for the fiscal year 2019, showing what they call their values in action. Kind of a high-level macro look at their governance, how they're doing on community scoring, employees. They're number 8 on Fortune's best workplaces for diversity 2019 list. Sustainability, 4 times more renewable electricity deployed. Now, again, this is just a high-level infographic they share. There's a ton of detail and data to back this up. They go through the report talking about practicing sustainability, what their renewable energy goals are, how they're going to get there, going all electric, saving money and saving resources. They look at things like their employee representation. You know, for Adobe, 33% of global employees are women. That's fantastic. 10.2% of U.S. employees are from an underrepresented minority population. Global gender pay parity 1-to-1. That's fabulous. And again, all of this is backed up by reams of data in these reports that they put out. And we'll show you a snapshot of what that looks like here in a minute. Record engagement. 96% of folks would recommend Adobe is a great place to work. That's important. As far as corporate responsibility and social responsibility is concerned, that's a big deal. And here we start to get into some of the more specifics on the data, with regards to their employees, ethnicity, community, organizations served, number of hours volunteered. It's amazing stuff. Sustainability, various metrics on the climate, percentage of LED and green certified buildings owned or leased, their CDP scores, total energy consumption coming from renewable energies. Looking at their scope 1, 2, and 3 climate change initiatives, verification statuses of various emission projects. Create change. Adobe says, we believe we have an obligation to be a leading corporate citizen, both in the midst of crisis and in the best of times. Look, it's imperative to recognize that no company is perfect. Every operation and idea has its warts and blemishes. While social investing criteria are important, corporate dialogue, consumer behavior, our behaviors, shareholder activism, and as we've all outlined here today, investor interest in ESG remains vital to, as Steve Jobs once said, quote, making a ding in the universe. To reiterate, the companies we select for inclusion in our ESG portfolio must still meet our requirements for high financial standards, sharp operations, and possess bright and dynamic futures. We know that climate risk is investment risk, but we also believe the climate transition and broader ESG initiatives present a historic opportunity. Together, we reason that this investment creed can provide an intersection for people to align their dollars with their values without sacrificing commendable returns over the long run. So to quickly summarize, ESG is an acronym meaning environmental, social, and governance. It's a growing space, both in terms of the private sector wanting to make a difference and investors' interest in placing their money with more ESG-minded companies. We can make a difference with our dollars, and we don't have to accept the myth of a trade-off between long-term performance and personal values. The purpose of business is not just to squeeze as much profit as possible for its shareholders. Rather, companies can and should do more within a broader mandate, a lens that impacts a larger stakeholder base. Albion's passion for ESG, a concept that runs through our core, has driven us to create a well-thought-out, carefully designed, diversified ESG portfolio for clients. And if you're interested, please reach out to your senior wealth advisor to see if ESG makes sense within the context of your broader financial plan. Of course, I am also happy to chat more about this anytime with any of you. Thank you so much for your time, attention, and interest in doing well by doing good. Thank you again.